Are skyrocketing property taxes in Texas giving you a headache? Are you frustrated with the idea of protesting because you really don't know where to start? Perhaps you've even tried but hit roadblocks. Whether you're buying, selling, or just navigating the property tax world, Charles Denson and his expert team at Gill, Denson and Company are here to help you seamlessly achieve your goals. Today I'm bringing you Charles, and he's going to explain to you all of the ins and outs of what it entails to use Gill, Denson and Company and make sure they have your back. No more feeling lost or shut down. They know how to get you the best outcome when challenging your property taxes. Watch this video interview, stay tuned till the end, and get the code to get your discount and learn how Gill, Denson and Company can help you assess your property taxes and get them set at the lowest level possible. I would like to introduce you to Charles Denson. He's with Gill, Denson and Company, and they are an organization that helps people with their property taxes. They're learning about them, getting them protested, and helping get them lowered. Correct? Is that a good summary?
Yeah, absolutely, Kim. Thanks for having me.
So, of course, everybody wants to know, why are my property taxes so high? Are they going to just keep skyrocketing? So what are property taxes, and why do we have what seems to be high property taxes here in Texas?
Yeah, for sure. So property taxes in Texas are a big deal. We're always in like the top 5 of highest property tax states. Fundamentally, Texas doesn't have an income tax, a state income tax. It does have sales tax, local jurisdiction sales taxes that are all different. And then all 254 counties have property taxes. So they range from like a little over 1% to 3%, depending on where you are. And the state reassesses your value every year. So each year as the market's been changing, the market gets stronger, your property taxes go higher. Subsequently, if the market goes lower, your property taxes go lower. But that's fundamentally why we have high property taxes in Texas, because a lot of people want to live here. A lot of people are moving here from across the country. And so as the market goes up, your property taxes are going to go up too.
So that's another question I get. So will property taxes go down? I mean, does it really happen?
It does happen. It does happen. So the state of Texas comptroller oversees all 254 appraisal districts. Their job is to appraise properties. And so they have a lot of different formulas to do that. It's a little bit different than like getting an appraiser to come to your house when you buy it. But what they are ultimately trying to do is come up with the fair market value on January 1st of the given year.
Okay, so when people get their property taxes, they usually get a notice like September, something like that, right?
Yeah, so it really starts in April. They get their notice of appraisal in the mail.
Okay.
Correct. And then they have until May 15th to protest it. If they don't get it in April, then they have 30 days to protest it. But 99% of people, it's May 15th.
Okay.
And then what protest means is you can go in and contend your value. So say your value is $500,000 on that notice, and you really think your property is worth $400,000. Then you file a protest, and you go in with evidence into a hearing to present your case against the county appraisal district. And so that process takes time. Typically in the summer months, between June and September, the counties hold those hearings into the early fall. As you can imagine, there's thousands of protests.
Right.
Still only like 10 to 20% of people protest every year because it's an educational thing, right? You're focused on your income taxes at that time of year. You may be new to homeownership. You don't really understand. It sounds like a scary word, protest, but really all it is contending the value. And so that's what like our company does. We're experts in going in, and we're appraisers to go do that and represent you. So a lot of people do that during the summer, and then you get your tax bill at the end of the year, November, and then it's due.
Oh, so it's November. Okay.
You get it in the mail, and it's due. It's also online, and then it's due January 31st. And the cycle repeats every year. And so if you pay like a monthly mortgage and you get your value lower, then your mortgage company will go lower your monthly payment. If you, if you pay all at once, then you have a lower tax bill at the end of the year when you reduce it.
Yeah. Well, what I see is I see more people with mortgages. They have problems because the mortgage company doesn't catch up. So they're behind, or they've overpaid, or, and then it takes a while to get that, their mortgage payment goes way up because mortgage company didn't catch up to the increase in taxes. And then all of a sudden they have to increase their, quite a bit.
Yeah, it's a bad sticker shock for some people, especially the last few years with the market changing, because the county is really working in arrears. By the time you get your tax bill at the end of 2024 here, you're talking about the value on January 1st of 2024. And then your mortgage company actually might be like a year late. They may be paying your taxes and paying those reserves. And then you get a letter in the mail. You're like, you owe the mortgage company this amount of money.
Right.
And then you call your realtor and you're like, well, what's going on? I thought my payment was going to be this. And but Kim knows what's going on with the taxes. So it's super important, right? It's kind of about, you want to make your underwriting correct from the get-go. You don't want to suppress the taxable value because, and this is something we help people with all the time. They may not even be a client, and they call them like, hey, I'm buying this house. What's going to happen to the taxes? And we can kind of give them a range. But
that's really important because, just talking to different lenders, I'll say, well, how did you come up with that amount? And, they'll use like a calculation or an estimate, just kind of throw it out there, like sticking pizza on the wall. I'm not trying to criticize. I'm just trying to say they're using a number that's not, I could come up with a more close number, but I appreciate that you can really do an even much more accurate job of pinpointing what it's going to be.
Yeah, and I think that's the emphasis of like working with a local realtor like yourself and a local property tax firm like us. Those mortgage companies may churn out a lot of mortgages and have a great system for it, but they could be a national company and they're not in tune on all the exemptions and kind of the ins and outs of taxes. And they could, I see it all the time. They could be $10,000, $15,000 off of property tax payments in a given year. And that's a big chunk of change for people to afford maybe their first home, and they didn't even know what property taxes were.
Right.
And so one of the common things is that previous owner has exemptions. So Texas has a lot of different exemptions. And you could be buying a house from a 75-year-old that's retiring and they had suppressed taxes, and you think you're getting the same taxes they had, and that's not the case.
Right. Yeah. The other thing I wanted to point out that I remembered what it was, I forgot to talk about earlier. When they do the appraisal, it is nothing like an appraiser. So they're driving by, they're sending a drone by. Do they do that every year? How does that work?
Really depends on the county. More rural counties will do things every few years with drone flybys, updating satellite images. They will have field appraisers that drive by, take pictures, try to see, especially with new construction, to see kind of how far along things are in a neighborhood. It depends on the resources of the county, and it depends on just the population of the county. Typically, you see suburban counties kind of as the most common because they have a lot more appraisers and they're growing.
Okay.
And they know that there's a lot of new developments. Your central Dallas or Harris or Travis, they know what's in their county, so they use more algorithms and formulas from the previous year. Right. So it's nothing like a appraiser coming in your house. We actually tell our clients that you don't have to let them in your house. It's better you don't. It's better. It's better that we set the honest burden of what is truly your makeup, because there's no reason to get taxed for things that you shouldn't be taxed for.
I like to tell people to make sure and look at their, what are they actually getting taxed for? Because I've found people that they're getting taxed on a pool that if they even had one, it was years ago, or they've never had one, and it'll say they have a pool, or it'll say they have outbuildings that they don't have and haven't ever had, or at least in their knowledge, they never had. And so, or a garage that was converted years ago, and they are still being billed for that garage,
Yeah.
Plus the conversion,
Right.
and so I'm like, you really, you need to really make sure that's accurate.
Absolutely. I mean, because these counties, they're mass appraising. So if they're doing a couple thousand properties at once with a spreadsheet and a formula, they could totally miss that you have a pool still on your tax roll. And we have ways to go and get that removed. There's formal procedures to remove those. But yeah, I mean, you take a pool, say it's a $50,000 pool. I mean, that's $1,000 on your tax bill that you could get removed if it was there. Same with a garage apartment. Sometimes they think the garage apartment is like a full apartment. It's really just a garage and a shed.
Right.
You need to classify that.
I've seen that too. What about if when I point out, hey, do you have a pool? And they say no, we've never had one, but it's been on there I can go back and see it's been on there for 3 years. Is there any way, is there a way to get that money back?
Yep. We call it it's called a 2525C correctional protest, and we can go back 4 years on the tax roll and correct something.
Okay.
You can't go back and talk about the value, like, I think my value is this in 2020.
Right.
But you can remove a structure or remove an error.
Okay.
And you go to a hearing and you prove it.
Yeah. With, I don't know how you prove that you don't have, I guess with pictures. I don't know how you prove that you don't have a pool.
Yeah. I mean, pictures are always great, right? Everything we do in our business, we're licensed as well. There's owner affidavits for truth, and that's a big deal. Sometimes that can get away, but usually in any hearing, you need evidence.
Yeah. Okay, so let's go on to homestead exemptions. And that's a big gray area, especially people that have just moved to the state. I tell them once they've owned the house since January 1st, then they can file for a homestead exemption. But before that, they're either riding on the person before them, right?
Yeah.
Or if there may not be an exemption on that property. So how does that affect them?
So first thing for anyone buying a house is their primary home. They don't have another primary home. File that homestead exemption right away. They changed that law a few years ago. Basically, yes, file as soon as you have your deed done. Just consider it part of your closing. File your homestead. It's free to do. Most counties have an online option. There's also a PDF you can email and mail in to the county. And essentially what this does is it provides credits on the jurisdictions, namely the school tax. So if you're in Dallas and you're in Central Dallas, you have the Dallas ISD school tax. It's about half of your tax bill. So say your tax bill is like, call it 2%. Your DISD tax is probably going to be about 1%. And it now provides up to $100,000 of exemption amount to DISD. So that's 1% of the 100,000. So that's $1,000 of savings on your tax bill right there. There is also, depending on the jurisdictions in the county, you also have other credits. So the fire department may have a small credit. The county road, there's tons of jurisdictions. There's thousands of them throughout the state. So that will save you, depending on the value of your home, it will save you a few $100s to a couple thousand a year. But the main thing that people love about the homestead exemption is the cap protection. So year to year, it protects your assessed value from going up more than 10%. So 10% is the capped amount it can go up. The common misconception with that, though, is it's after you've been there for 1 year on January 1st. So as an example, let's say you buy your house here in January 2024. It's 500,000. You get your notice in the mail. It's for 550,000, and then you protest it. Let's just say it stays at 550, and then next year in 2025, you're actually not protected by that cap because you didn't have it for 12 months on January 1st, 2025. Then say it goes up to 700,000 in 2025. Okay, you protest it. Let's say it stays the same, just as for simplicity. 2026, you're then protected by the cap. It cannot go up more than 70,000. So it'd be at 770,000. So I know that's a lot of info at once. Just the main benefit though is your assessed value can't increase more than 10% after you've been there for a year on January 1st.
Okay.
If you add a pool later down the road, you add a garage apartment, it can go beyond that cap. So it's for what that property is on staying the same on January 1st.
Okay. So let's say I did add a pool. Then does just the pool get increased, or the whole property goes up as a whole?
Just the pool.
Okay, just the pool. Okay.
And depending on the county and kind of the city you're in, some cities and appraisal districts sync up well on the permits, so they kind of know the scope of your project, but some don't. And so they'll see a change, and the whole thing could like temporarily reset, and like your value jumps hundreds of thousands when you added just like $100,000 pool. So then you need to be able to go prove the actual cost of your pool, and then say, okay, the rest of my house and land is protected by the cap, the 10% cap. And that's an important protest.
Okay, yeah, I can see that. So what other things? Okay, so there's a lot of other exemptions.
Yeah, exemptions. So another very common one is for people over 65. And so it's for married couples, it's just the first person that turns 65. And what they do is they get an extended, they get a little bit more exemption. So there's some legal changes to that. It functions the same as what I mentioned about the school tax exemption, but the main two benefits for them is it's when they turn 65 in that tax year, it's going to freeze the tax amount. So if you're being taxed at, if you have a $500,000 house and you're being taxed at $400,000 for the school district and you're paying $8,000 a year in school tax, it's going to stay at $8,000 forever until you move, sell the house, establish a new homestead. Doesn't really matter what happens to the value. That tax ceiling is going to be frozen. Other jurisdictions do it as well. The school tax is the main thing. There's a lot of misconceptions that you don't have to pay tax at all at 65. That's not true. I wish it was, but you do. You know, for elderly people that you know, they are towards end of life, and it's you know, they're on a month-to-month income. They actually do have a deferral program that you don't have. They won't kick you out of your house or place a lien on your property if you don't pay the tax. But once you are deceased, the tax will be due. Sad thing to talk about, obviously, but it is something that, you know, as people become elderly and the prices rise, because the rest of your tax bill can change. And you look at over a 20-year period, and you may have been retired for 30 years, it does come into factor for people and their parents.
Yeah, because a lot of retired people are on a fixed income.
Yeah.
So do they have to do a separate application for that to hold like that, so they don't get a lien against their house?
It depends on when. So if you put your birthday in on your homestead application, they will automatically do it, and they'll automatically do it when you turn 65.
Okay.
We help all of our clients just make sure that is on file. A lot of people just forget to check that box, and they need to let the county know they've turned 65.
Right.
Yeah. And then it's a very complicated one, but a small benefit is if, and it's really county to county, you can transfer your tax ceiling portions of it if you do move. You move your homestead within Texas. they'll work with you on that.
Yeah, I've heard that, but I don't really understand it well enough to know how it works. So you're a good resource for that.
Yeah, and honestly, like the formulas change every year. So if we have someone that needs to do that, we get on the phone with the county and them, and we talk through it, get them the exact details. There's also there's exemptions for VA and disabled and military. There's basically the only people in Texas that don't pay property taxes would be a 100% disabled veteran, and so that's based on what the VA establishes. Also, like churches, government buildings, they don't pay taxes, but it's not like federal income tax. There's no way to just write off everything and not pay property tax. If you're losing money at your real estate investment, you're still going to be paying property tax.
Right.
Yeah.
I've had some 100% disabled who actually sold their property, moved to a different county. And then that was a lot of hoops to jump through because apparently it's county to county. And, they have to make sure that they're going to be able to carry that over and make sure the VA person helps them, get all that smoothed out.
Yeah. And usually people that they have that disability classification from the VA, they're in close contact with the VA and they know that they need that exemption. But if you are, in the military and you do have disability and you own a property and you're not getting that, it's definitely a great option.
Yeah, definitely worthwhile.
Yeah,
to get that benefit.
Yeah, and there's tons of military bases in Texas, so it applies to quite a few people.
Yeah, plus there's tons of people that come here to retire or because of a lake or the weather or, whatever it is. Yeah.
Yep. And then the last kind of main exemption is for ag, wildlife, timber. So ag is the biggest one. So essentially, if you do have an ag exemption, it takes 5 years to establish. It's for ranches that can prove the productivity of their agricultural, mainly cattle, but there's other, goats and whatnot. And they pay very little tax if they do establish it because they are proving the productivity of that. It's a vital part of the Texas economy, so it's built into the property tax code to have that exemption. I would think it would be a very rare day that the ag exemption was ever changed. It's a huge exemption, so you could have a $10 million ranch and pay a few $100 of property tax because you run a cattle business.
Right.
And it's a very strict, it's a timeline to follow. The county does have to come out to your land, count your heads. You have to turn in documents every year to prove it and your receipts at auction and whatnot. So tons of people take advantage of that, and rightfully so. They own a ranch. We see some kind of an upstart more in like Central Texas where the weather is good for it. People have beehives. They manage those. They can do it on a smaller tract of acreage. Mostly for ag, for cattle, you typically have to have over 10 acres, depending on the county. And then wildlife timber, we see that a lot in East Texas, where it's similar to the ag. They have to prove that they're in the timber business. Those are, anyone that's in that business knows they need that exemption. But they still want to they still want to look at their market value, because if they ever lost the ag and they sell it to a developer, which happens all the time, where Texas is a growing state, they sell that land to a developer and the developer starts building and they no longer have that exemption. They're not in that business anymore. Well, there could be a rollback period. It could be hundreds of thousands of taxes. So they call us and they want to know about the market value, or they might be handing it off to their kids and their kids are going to do something else with the land.
Yeah.
So it's a pretty complicated tax problem if you ever move that exemption around. But there's people that have operated a ranch for decades and decades and suppressed their tax bill.
Yeah. So if kind of on ag exemption, if I had a ranch and I was going to plat it out and sell it to a developer, who pays that rollback tax?
it would depend on your contract with that developer.
It says the seller does usually. I mean, I don't know,
Okay.
maybe with a developer, when they're paying you millions of dollars, it might be a little different, but
Yeah.
the general language, but I always wonder, what if someone just buys it because it has a home on it, a homestead on it, and then they develop it? Well, then
Right.
that would fall on them. Right?
So each county has exact formulas posted on how the rollback is calculated. Essentially, fundamentally, it's whenever that exemption the use of it is removed.
Okay.
So they'll be prorated for that year, and they can go back in time. I mean, if you think you have it on there accidentally for a few years, and you haven't operated that act, you're probably in a rollback situation where they'll find out. But just like how you can go back 4 years, the county can too for that. Now, the county's not going to go back for determining your market value. That's very defined year to year. But for something like an ag exemption and how serious of an exemption it is, they can go back in time. So as a seller, you want to be really close to your realtor, if you have an attorney as well, and just the other party to know that there could be a rollback.
Right. So what, you said, what percent of people usually protest their taxes? What was that percent you said?
About 10 to 20%. Forever it's been like 10%, but the last few years, I think people have been freaking out, right?
Yeah, when values kind of steep, took a steep increase, then people were like, whoa, wait, what?
Yeah, and then the Texas legislature's done that. This past year was a big one, but then a couple years ago they did some other stuff as well. So, people are definitely talking about it, right? But if you don't protest, there's really nothing to lose. So if you protest, you're not going to raise your value. The worst that can happen is if you're underassessed, you're underappraised, you can just lose the hearing or withdraw and your value is sustained. I think a lot of people that may not protest or not know what it is, they look at their value online and they go, well, I'm happy with that. My house is worth $700,000, but really, I mean, they call you, Kim, and you're probably like, well, it could be, much more. The tax appraisal is just a mass appraisal method. We got to look at kind of the finer details, and that's what you do in a protest too.
Yeah. And they compare, when you protest for someone, when you help them gather that data, what kind of things do you do?
Yeah, so it depends on the property type, but like a residential house, for example, we're going to look at four main things. So as an appraiser mindset, we're going in and looking at sales comps and adjusting for size and location, condition. Typically we're looking in your neighborhood. If you are in a rural area, we might have to kind of get more creative of where we're pulling from. So we want to pull 3 to 8 comps to be prepared for a hearing, and we want to pull the best ones, right? We're looking at the low end of a spectrum. If you got an appraisal on your house, you're looking at the high end. You want a better mortgage. We're looking at the low end. So sales comps is huge. I mean, the property tax code is about establishing the fair market value, and that comes down for a residential house. They're valued on a sales method. Alternatively, they're also valued on a cost method, and we want to go with whichever one is lower. So the cost method is observable building costs, so roof, lumber, foundation, concrete, windows, all of the standard costs for that year in your area. So we have software that goes in and looks at that. The county does too, but they may be making incorrect assumptions. So that's a cost approach. From the cost approach too, we can actually back out deferred maintenance. Extreme situations could be if your house caught on fire. Most commonly, deferred maintenance, you just haven't updated your roof. It's 20 years old. It's a depreciating portion of your house. So we need to look at the quotes that you've gotten, back that out of the cost approach, and then we can go in. That's a really great way to reduce property tax. You got to be very documented on the cost approach. You can't just take pictures and say, okay, this is run down, because what the county will be prepared to say is, okay, that's your cost approach, fine, but we have a sales approach. and house next door is selling for a lot, and look at their condition. So you got to be prepared for both. And then the third thing we look at is the fair and equal values. So counties have gotten more sophisticated. They have good formulas, like in master plan communities. It's going to be rare that you find like a lot of fluctuation there. They're going to apply the same formula to that neighborhood. But when they start skipping around neighborhoods or neighborhoods that are not master planned, they may be giving someone a grade of certain strings of their formula that they're not giving to the other person. Right. And so you can pick that up pretty quickly. And that's called fair and equal is kind of the jargon, but it's called the equity approach. Mm-hmm. Is it equitably fair? And then the fourth thing we look at is what you bought it for. So if you bought it in the last 2 years, we want to know how much you paid for it. We want to have that closing statement. And it's really not, these counties, they're not like trading in your sales price. There's time adjustments to January 1st. Everything's about January 1st. So there's kind of a misconception if you can just say, oh, trade it into what you bought it for. Some counties may work with you that way, but most these days don't. And we want to look at the lowest of those four things. We want to look at the lowest.
And that's what you would go in strong with, is what comes up the lowest. What
Correct.
is beneficial.
Yeah, and you want to negotiate. You want to have that informal sit down. So we like to sit down with the county and talk to them about the facts, because they're appraisers too. People that work in their office are good guys and girls, that they understand the appraisal. They know us, and they know that we have a good reputation for showing them what it is. And so a lot of what we do can be done informally. And then if need be, if us and the appraiser don't agree, then of course we go to the formal hearing. We even go to litigation. I think a lot of property owners that do it by themselves, you can do it for free, right, by yourself. But the counties, especially the bigger ones these days, they will give you kind of a go away offer, because they have so many protests being filed. They'll say, okay, Kim, thank you for filing. Here's a 2 or 3% reduction. We'll close out your account. And some people take that. They may not have the time. They have their own job. They like that. Or you can push harder and dig into it.
Okay, so I've had people who were listing their house for sale, but when we start talking about their property taxes, they really should protest them. And they're like, why should I protest them? I'm selling my house.
Yeah.
That might decrease the value. People will think it has a decreased value or something like that. But really, they're paying the taxes through the end of the year.
Yeah.
When they sell. So it seems to me it's an advantage to protest, to get them.
Absolutely. My rule of thumb is if you own it kind of after the midway point of the year, go ahead and protest it. Mm-hmm. So if you're going to own it through June, protest it, because you're going to be paying half that tax bill at closing.
You're going to be paying it until the day of closing. I said the end of the year, but I meant to the day of closing.
Yeah, you're paying it to the seller. And it's in the best interest for both y'all to protest it and try to get that value down. Now, if you're selling it, selling it in March, you're not going to be like thinking about the protest deadline is not until May 15th, but you're only paying 3 months of the tax. You probably want to sell the house and move on. But that's the part of the educational part. Like this, if you think the tax appraisal is the value, I think the counter question to that is like, do you want to pay more taxes? Like it's more valuable of a property to be suppressed. And you see that a lot in like commercial assets, that they're not going to buy a property with a high tax appraisal that hasn't been protested, because it's just throwing away money. Right. We see, so for going back to your situation, you see, so, if they protest the taxes May 15th and they sell it, say July 1st, we work with them to either continue, we continue with that client to protest it, and they get their refund from the buyer. They both know that they're protesting, and that's what they want us to do. That's the most common. Some people say, they call us and they say, hey, can you transfer our account to the buyer? they want to continue the protest with you, but I sold the house, I'm done. We do that too. And we make that free and easy for them. Yeah.
Okay. Well, that's good to know.
What you don't want to happen is if you're selling it and then you haven't had your protest hearing, and then we can't go to the hearing because, you've sold it and the buyer, and then everything gets canceled, and then the buyer is like, hey, I thought we were protesting. So we try to tell everyone, if you're selling, let us know.
Proactively, that way you can make sure it all happens the way it's supposed to happen.
Yeah. And it would be the same day, like basically the same day. Like if you're selling, if you're closing on July 1st, we had ones that we were settling the day before, going to a hearing the day before and certifying the value. And then the title company updated it like that morning. It was, in that case, I think it was like a $4 million reduction. So it was a big deal for their closing. Yeah. So they wanted us to go up to the wire. And even if they had closed, they were going to say, hey, just continue the protest. And, our TREC contract actually says that the seller and buyer need to settle up out of closing. That's more your department, but you can, in more sophisticated cases where it's more than a few $100, people during the protest season care about that protest continuing.
Yeah. So tell me a little bit about your company. Like, do you have like a license? Do you, tell me about that.
Yeah.
Just educate me.
So we do have licenses. Real estate brokers and salespeople have licenses. Property tax consultant is a license as well. And so it's very close to what an appraiser license is. There's a certain amount of education that goes into that, field work, and then prerequisites. So I'm actually also a real estate broker. I don't practice real estate brokerage, but I, for myself and my own properties. So I attach that to my property tax license. But on my team, I have people that are property tax licensed, but also appraiser license. We have a CPA, we have an attorney, we have 2 attorneys. And so it's kind of, there's a few different property tax things we do, and it kind of depends on the situation and what kind of personnel, but we are overarching, we're property tax consultants. So when people sign up with us, we become their authorized agent to represent them and make decisions on their property taxes. That's why there's a lot of regulation in it from the state. It's not, you don't have to be an attorney, but it's close up. It's close up to that. Sometimes people call us and think we are attorneys. There are attorneys that protest property taxes, but we're not a licensed attorney, law firm, property tax consultant.
You just have attorneys that work with you.
Yes. Yeah.
Okay.
Work in our office. Mm-hmm.
So if I was going to buy a home and I'm going to call you and, ask you about what will my taxes be and all that, does that cost money?
No, not at all. So
when does it start costing money?
Once you sign up and engage us, you sign a DocuSign and we go attend hearings and negotiations and lower your tax bill. So we charge you when we lower your tax bill. We're based on performance. And so a lot of people have a lot of unique tax situations. They like to call us and get to know us and even ask us questions, even if they don't work with us. So your clients and friends can definitely do that, especially when they're buying a house. I know that's when a lot of questions come up.
Yeah. A lot of questions, or I'm trying to help them understand. And if they've never owned a home or they're not from Texas, that's a lot of information, plus all the other information I'm giving them, so your service is really valuable.
Absolutely. And I think, you obviously know a lot about property taxes. I'm impressed with what you know. And so, I think when your clients talk to you, you're giving them so much information. When we get into the weeds of all the taxing jurisdictions and exemptions, just tell them to call us and we'll know the answers, because you got a lot else on your plate with the brokerage and the transaction.
Yeah. Plus, I have a lot on my plate, but really I feel like talking to someone who's an expert in that field I'm not giving advice that maybe more that could really help them.
Right.
I mean, you will know more.
Yeah, it's just, it's your biggest expense typically of owning the home. And it's the same reason why you would have an insurance agent or a CPA to do your taxes, or an attorney to represent you in court, property tax to represent your property tax matters. It's just part of owning a house in Texas.
Okay. Yeah. So do you have a set fee, or how does that work?
So we have a sliding scale of 25% to 40% of the savings on your tax bill. For your friends and clients, they can enjoy a discount. So we'll charge 25% of what we saved them. So they can reach out to you and use that code. We'll also post it here at the bottom. So it's purely based on the savings. So we go in and we reduce your appraisal value in that year from $500,000 to $400,000. Say your tax bill is 2%. That would be $2,000 of tax savings. We charge 25% of that, so it's $500, and then you net $1,500 on your tax bill. So it's very simple. If we go in and we don't reduce your taxable value, and that's your tax bill, we don't charge you at all. So it's purely performance based.
Okay.
Yeah.
Well, that makes sense to me.
Yeah.
Pretty easy to calculate too.
Absolutely.
Well, is there anything that, I know there's a lot about taxes and property taxes that we haven't covered, but are there any things that I haven't asked that you would want to throw in there?
I think we hit some great topics, Kim. I think the one thing that's coming up a lot now here, we're in January of 2024, is the new tax law, the new proposition that was voted in November. I think like 86 of people voted for it. So it's popular. The main benefit is that non-homesteaded properties under 5 million. So think about vacation homes, little mom and pop rental properties, which is a very majority of homeowners. Before they were not capped at an increase. So they could get that bill in April and it's 100% increase, and they have to fight it and pay it. Now they're going to be capped at a 20% increase. So similar to how the homestead works, capped at 10, those folks will be capped at 20, which kind of looking at the last few years and those types of properties, that should save them thousands as the market goes up. Now, if the market stabilizes or goes down, it's not going to be that relevant, but 20% is a lot. You still want to protest it. That's a big deal. We also saw some increase to that homestead exemption, which I actually included that in what we talked about earlier. So they're getting the $100,000 school tax credit. And then the state came in with a surplus and bought down like 10 cents on the dollar of school tax. So everyone enjoys that. It's a few $100s on your tax bill, depending on your value. But property taxes are not going anywhere anytime soon. That tax bill did some work. There's probably a ways to go for it for reducing taxes, but it will help out, especially those secondary homes. I think that's the big winner of that legislation.
Right.
But if you're looking at your property taxes and you can't figure it all out, it's kind of confusing or boring, just give us a call and we can help you.
Yeah. One thing about the proposition that got passed, when I was talking to people about it, the biggest concern I heard from people was, well, they're just going to increase the value of all of our properties, and then they have to make that money up somewhere, right?
Well, it doesn't quite work like that. It's a misconception. I mean, the appraisal district they have to stick to appraisal methods and their value. It's going to be off because they're doing so many at once. Where the kind of the nasty part of it is the tax rate. So if you're seeing tax values go up, tax rates are typically going to go down a little bit. And if you see values go down, the tax rates are going to go up a little bit. The tax rates are heavily regulated. They can't change by exaggerated amounts, and they're voted upon. Like, you're going to go vote for your school tax, and then that's considered into their budget, and they come up with a final number. But essentially those governments are funded only by property taxes. They're not funded by sales tax. There's no state income tax. So they're going to have to collect a certain amount of money. And so it's that tax rate's going to slightly change each year. And that money that minimum amount of money gets kind of pushed around. So the people that really are stuck losing are the people that don't protest, and they're just going to pay their tax bill.
Right.
It's not something you need to like worry about. You can't protest your tax rate, but yeah, the tax rate will fluctuate, unfortunately.
Okay.
Yeah.
Well, I really appreciate this conversation.
Yeah.
And I'm looking forward to recommending you to the majority of my clients, because I think that you will save them money, even if it's because they're more aware of what they need to do, or how they can save some money.
Absolutely. As long as they're in Texas, we can help them. If they go to the Oklahoma border, unfortunately, we can't help them. It's not a Longhorn Sooner thing. It's just so it was great to join you, Kim. Thanks for having me, and just let us know if you ever need anything.
Okay. Thank you.
All right. Bye-bye.
Bye.